Options. What are options, and can you become a millionaire with the use of this financial instrument? If you are indeed pondering about this precarious question, you have come to the right channel and you have managed to select the appropriate video. Because in today's easily comprehensible video, you will learn the answer to this fairly simple yet very significant question. So without further ado, my name is Daniel and welcome to the Greenwave. Option is a financial derivative or instrument that is based on the value of underlying securities such as stocks. It gives the buyer a right but not the obligation, and so this right here is a very important distinction. It's only the right, it's not the obligation to buy or sell that underlying asset at an agreed upon price and date. Unlike futures, the holder is not required to buy or sell the assets if they decide against it. The stated price on an option is known as the strike price. Moreover, you can buy or sell options through online or retail brokers, and they are often used for hedging. Now, although there are many opportunities that allow you to profit from options, investors should carefully weigh the risks. Firstly, let's differentiate between the different types of options that exist. The main two types of options are call options and put options. Call options allow the holder to buy an asset at a stated price within a specific time frame. Put options, on the other hand, allow the holder to sell the asset at a stated price within a specific time frame. Each call option has a bullish buyer, so someone who believes that the stock will go up in price, and a bearish seller, so someone who believes that the stock will go down in price. Whereas every put option has a bearish buyer and a bullish seller, which is essentially the opposite of a call option. These financial derivatives are mostly used by investors to hedge or reduce the risk exposure of their portfolios. The second differentiation that is important to make is the difference between American and European options. So on one hand, we have the American options, which can be exercised at any time before the expiration date of the option. Or contrarily, we have the European options, which can only be exercised on the expiration date or the exercise date. And so exercising means utilizing the right to buy or sell the underlying security. Also, it is important to know that the premium is partially based on the strike price or the price for buying or selling the security until the expiration date. Another factor in the premium price is the expiration date. So for instance, just like with a carton of milk in the refrigerator, the expiration date indicates the day when the option contract must be used. The underlying asset will determine the use-by date. For stocks, it is usually the third Friday of the contract's month. Okay, now here we could proceed to talk about option spreads and risk metrics, aka the Greeks, which include the delta, gamma, theta, and many others. However, that is outside the scope of this video, so if you would like to see us cover these more advanced topics in the future, certainly let us know in the comments below. Now, let us proceed with an options example, shall we? So suppose that Microsoft MFST shares trade at $108 per share, and you believe that they will increase in value. So you decide to buy a call option to benefit from this increase in the stock's price. You purchase one call option with the strike price of $115 for 1 month in the future for 37 cents per contract. So in this case, your total cash outlay is $37 for the position plus fees and commissions. We get to this number by multiplying 37 cents by 100. This is because an option contract usually represents 100 shares of the underlying security. If the stock rises to $116, your option will be worth $1, since you could exercise the option to acquire the stock for $150 per share and immediately resell it for $116 per share. The profit on this position would therefore be 170.3%, since you paid 37 cents and earned $1. So this profit is much higher than the 7.4% increase in the underlying stock price from $108 to $116 at the time of the expiry. In other words, the profit in dollar terms would be a net of 63 cents or $63, since one option contract represents 100 shares. So the calculation here would be $1 minus 37 cents times 100, which equals $63. Contrarily, if you were wrong in your prediction and the stock fell to a price of $100 per share, your option would expire worthlessly and you would be out the $37 premium. So the upside of this trade is that you didn't buy 100 shares at $108, which would have resulted in an $8 per share loss or $800 in total. Thus, as you can see, options can help limit your downside risk. So, in conclusion, options can be very useful as a source of leverage and risk hedging. For example, a bullish investor who wishes to invest $1,000 in a company could potentially earn a far greater return by purchasing $1,000 worth of call options on the firm as compared to buying $1,000 of the company's shares. In this sense, the call options provide the investor with a way to leverage their position by increasing their buying power. On the other hand, if that same investor already has exposure to the same company and wants to reduce that exposure, they could hedge their risk by selling put options against the company. However, the main disadvantage of options contracts is that they are complex and difficult to price. This is why they are considered an advanced investment vehicle, suitable for only experienced professional investors. In recent years, they have become increasingly popular among retail investors because of their capacity for outsized returns or losses. However, investors should make sure they fully understand the potential implications before entering any options positions. Failing to do so can lead to devastating losses. And there you have it, a succinct explanation of options as a financial instrument. Hopefully this video cleared it up for you, at least a little bit. If you have any further questions, certainly feel free to ask them in the comments below. Additionally, if you liked the video, consider dropping a like, sharing and subscribing for more financial content. So thank you very much for watching and see you next time.